Chelsea have spent £144 billion on transfers since Todd Boehly took over in May 2022. That is more than double what Manchester United, the second highest spenders in the same period, invested in the same 3 seasons. It is a figure that, historically, only nation-state-owned clubs even approach in a single decade, and yet, for 2 of those 3 seasons, Chelsea told the Premier League's financial regulators they had not broken the rules. In 2023-24, they officially posted a profit of £128 million. The year after, they posted the single largest pre-tax loss in English football history, £355 million. The gap between those 2 numbers is not bad luck or mismanagement. It is an accounting strategy that exposes a structural flaw in how football financial regulations are designed, and the evidence is written across 3 separate numbers that almost nobody has connected in sequence. When Clearlake Capital and Todd Boehly purchased Chelsea in May 2022 for £4.25 billion, they made their investment thesis clear almost immediately. They were not going to run the club like Roman Abramovich, writing personal checks to cover losses. They were going to build a commercially sustainable club through player value creation, buy young, sign on long contracts, develop, sell at a profit. The strategy was not irrational. It mirrored how successful private equity firms operate in other industries: acquire undervalued assets, hold them on the balance sheet, and exit at a premium. The problem was the execution, and specifically the volume and pace of spending, which bore no resemblance to any disciplined capital allocation model. In the 2022-23 season alone, their very first full window, Chelsea spent €612 million. That single season's outlay was larger than Real Madrid's entire decade of net transfer investment. They signed 40 players in roughly 2 years, averaging £33 million per signing, and they did it through a specific accounting mechanism that existing financial regulations at the time had not anticipated. Premier League PSR rules allow a maximum loss of £105 million over a rolling 3-year period. UEFA's equivalent threshold sits at €60 million over 3 years. Chelsea needed to spend £1.44 billion and remain inside those limits simultaneously. The question is, how? Here is the accounting mechanism at the heart of everything Chelsea did, and once you understand it, the entire strategy becomes logical, even if its consequences were not. In football, transfer fees are not expensed immediately in the year of purchase. They are capitalized as intangible assets and amortized, spread as an annual accounting charge, across the length of the player's contract. A club spending £100 million on a player signed to a 5-year deal books £20 million per year. Standard practice, used by every club in Europe. Chelsea saw an opportunity in the contract length variable. If the same £100 million player signed an 8-year deal instead of a 5-year deal, the annual amortization charge drops to £12.5 million, a 37.5% reduction in the annual accounting cost for the exact same transfer fee. Apply that principle across £1.44 billion in spending, and the numbers become extraordinary. Enzo Fernandez joined for £106.8 million on an 8.5-year contract, an annual amortization of just £12.6 million compared to £21.4 million under a standard 5-year deal. Moises Caicedo signed for €115 million, also on an 8-year term, annual charge of €14.4 million rather than €23 million. Mykhailo Mudryk, an 8.5-year deal. Christopher Nkunku, Cole Palmer, Romeo Lavia, all signed on contract structures that spread the amortization charge significantly further than industry standard. What I see when I look at Chelsea's transfer ledger from 2022 to 2023 is not a football club in an aggressive recruitment phase. It is a balance sheet restructuring exercise deliberately designed to minimize the annual accounting charge of the world's largest peacetime transfer program. The total headroom this strategy created, when applied across the full £1.44 billion portfolio, amounts to hundreds of millions of pounds in reduced annual amortization charges versus what a standard 5-year contract structure would have produced. That headroom was the mechanism that kept Chelsea inside PSR thresholds, and this felt like it will continue over and over again until the regulators noticed, and they moved quickly. In the summer of 2023, UEFA changed their financial regulations. Amortization for FFP compliance purposes would now be capped at a maximum of 5 years, regardless of actual contract length. If a club signs a player on an 8-year contract, the contract still runs for 8 years, but the amortization charge for financial fair play purposes is calculated over 5 years, producing the same annual charge as a 5-year deal. The Premier League clubs voted to implement the same 5-year cap shortly after, with Chelsea among those who voted in favour. despite having built their entire transfer strategy around the longer amortization window. The key detail here is timing. Chelsea's existing contracts were grandfathered in. The cap applied to new deals only. Fernandez's 8.5-year amortization, Caicedo's 8-year schedule, Mudryk's 8.5-year spread, all of them remained under the old rules. Chelsea had already locked in the accounting advantage before the regulation closed it. New signings from summer 2023 onward had to use the 5-year cap. By the end of the 2023-24 season, Chelsea faced a problem. Despite the amortization strategy, their cumulative losses were approaching the PSR limit. They needed to generate a significant accounting profit quickly or face a potential breach. 2 days before the Premier League's financial registration deadline for the 2023-24 accounts, Chelsea transferred ownership of Chelsea FC Women to their parent company, Blueco 22 Midco. The transaction generated a profit on disposal of £198.7 million in Chelsea's accounts. That single accounting entry transformed what would have been a substantial loss into a pre-tax profit of £128.4 million for the year ending June 30th, 2024. To be precise about the mechanics, Chelsea Football Club sold an asset, their women's team, to a related entity controlled by the same owners. The men's club booked the difference between the carrying value of the women's team and the sale price as profit. It was entirely intra-group. No cash arrived from an external party. The owners effectively moved an asset from one pocket to the other, and Chelsea's income statement improved by £198.7 million. This is the entry that stops me cold every time I look at these accounts. It is not illegal. It is not even unusual in corporate finance. Intra-group asset transfers happen all the time. But in the context of PSR compliance, where the entire purpose of the regulation is to prevent clubs from spending money they have not genuinely earned, booking a £198.7 million profit from selling an asset to your own parent company raises a fundamental question of regulatory intent. The Premier League launched a review into whether the women's team sale reflected fair market value. As of the most recent reports, Chelsea have confirmed compliance, but acknowledged that the conclusion of the review could result in a significant adjustment to the gain reported. While Chelsea were managing their Premier League PSR position, UEFA were running their own parallel compliance process, and the numbers there were harder to manage. Chelsea entered into a formal settlement agreement with UEFA, which permitted the club to operate under a projected deficit outlined in an agreed business plan. That settlement is what prevented UEFA from imposing harsher sanctions, despite Chelsea's rolling 3-year loss reaching €622 million, a figure that is, by any measure, many multiples above UEFA's €60 million threshold. In 2024-25, the full scale of the situation became visible in a single number. Chelsea posted a pre-tax loss of £355 million, the highest annual loss in English football history. Against revenues of £491 million, their combined wages, operating costs and amortization charges exceeded their income by £355 million in one season. They also paid a €31 million UEFA fine for 2 separate financial regulation breaches in the same year. Here is what everyone gets wrong about Chelsea's financial strategy. Chelsea's approach was not just about managing annual losses, it was supposed to generate profits through future player sales. The private equity logic was, buy young players, sign them cheaply on long deals, develop them, sell at a premium. The amortization strategy was the interim mechanism to stay compliant while the squad appreciated in value. The problem is the book value trap, and it is now the most serious financial constraint Chelsea face. When a player is signed for £80 million on an 8-year deal and has served 3 years of that contract, his remaining book value on Chelsea's balance sheet is £50 million, 6¼ years of £12.5 million amortization still to come. To sell that player without booking an accounting loss, Chelsea need to receive at least £50 million in transfer income. For a player like Mudryk, whose form has been inconsistent and whose market value is widely estimated below his book value, that sale is nearly impossible to execute profitably. At the end of 2024, Chelsea's combined squad had a total book value of £1.7 billion, the highest of any club in the world. That number represents the total remaining amortization charge sitting on their balance sheet. Every year that passes, that charge hits their income statement whether they like it or not. The real reason nobody fully explains Chelsea's financial position is that 2 contradictory things are simultaneously true. They successfully used the amortization loophole to stay PSR compliant during a £1.4 billion spending program, and in doing so, They created a balance sheet so loaded with high book value, difficult to sell assets that extracting themselves from the position may cost more than the original spending ever saved. They deferred the problem. They did not eliminate it. And the 5-year amortization cap that now applies to new signings means the old lever is gone. The bill is arriving, and it will arrive every year on schedule until those players are either sold or their contracts expire. Accounting strategies can defer compliance consequences. They cannot eliminate underlying economic reality. Chelsea's squad cost them £1.4 billion. That cost will sit on their balance sheet, in one form or another, until every one of those players is sold or every one of those contracts expires. The amortization mechanism spread the charge. It did not reduce it. If you found this Chelsea's financial breakdown story interesting, you will absolutely be fascinated by this next video where I break down why the world's best clubs lose billions every year. Click it, and I'll see you there. Cheers.